This is the Build Wealth Canada podcast, episode number 39.
Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hey, it's Cornell and welcome to the Build Wealth Canada show. I hope you had a wonderful holiday. Welcome to the first episode of 2018. I hope you had a good time. I had a pretty crazy, scary December. I actually ended up in the hospital, which is why I didn't have an episode in that entire month. So things got pretty bad. I was there for almost a week. But yeah, the recovery seems to be going well. I'm just kind of recovering now, but feeling good enough to do, the episode here and there as well. So thanks for tuning in. This is a really good one. I hope you like it. And so today I'm excited to have Ed Rempel on the show, who is one of the top financial planners. And he's actually one of the guys that I go to whenever I have questions or need a second opinion about my investments or about some of my financial planning that I do myself or on how to minimize my taxes. So he's been a certified financial planner, so a CFP professional for over 22 years, and he's been a professional accountant for over 33 years. So he has a CPA and CMA designation, which basically, to put things in perspective, so I'm 33 right now, so he's been a professional accountant for over 33 years. So, as long as I've been alive. So I thought that was, pretty impressive. And personally, I found out, when I ask him questions, his decades of experience as both a financial planner and a professional accountant has really helped me feel secure that he has all the bases covered, as he essentially has a holistic view from both of those worlds due to all of that experience that he has. So it's great. And I mean, he's written nearly 1,000 financial plans for Canadians over that time. So he's truly, I would say, as one of the kind of as experienced as it gets in the field. And he does have extensive knowledge on some of the higher level investment and financial planning strategies that can really help accelerate our returns. And this is what we're going to focus on in the interview. All right. And if you like what you hear from Ed, you can actually sign up for a free 30-minute consultation with him, where you can ask him some of your questions. And you can get that by going to buildwealthcanada.ca/ed. So just ED. So buildwealthcanada.ca/ed. And I thought it would be neat to send you a little bonus with that too, just to kind of help you, maybe even come up with some questions. So if you sign up, you'll also automatically get a guide on the top questions to ask your financial advisor or your financial planner. So these are questions that you can ask Ed if you want, or if maybe you already have a financial planner or advisor, then you can use those that guide to really kind of test how good they actually are and if they are still a good fit for you as well. So once again, in case you missed it, to get the free 30-minute consultation with Ed and the guide on the top questions to ask your financial advisor, you can just go and sign up at buildwealthcanada.ca/ed. So just ED. All right. Now, before we get into the interview, I do want to make another kind of big announcement, and that's that the show sponsor, which is paytm.ca, is actually giving away an iPhone 10. So that's a $1,300 phone, at least, which is really, really cool. So to qualify for the contest, all you have to do is use the Paytm Canada app to make a bill payment of at least $50 with either your linked bank account and or Paytm Cash. So it's that simple. You basically have to just make a $50 plus payment, essentially, using the app just to pay one of the bills that you pay anyway. And to get the app, you just have to go to paytm.ca on your Android or Apple device. Now, the contest will end at 11:59 p.m. Eastern Standard Time on January 31st, 2018. So in other words, at the end of this month, so January 2018. So don't let this slip. All you really have to do is take 10 minutes to get the app, pay your first bill. And this is just bills that you're going to be paying anyway. So just do that. You can get some cash back on that as well. Plus, you'll be entered into the contest, and then you're all set for the giveaway. Now, to get more details and even get an extra $10 free just for trying the app, you can go to the episode show notes at buildwealthcanada.ca/39. So just the number 39, and all the details and links are in there as well. Now, if this is your first time hearing about Paytm, it's an app that basically helps you manage all your bills in one place, and you can get up to 2% cash back on the bills that you pay through the app, and it can even get as high as 10% cash back on certain purchases. So it's a really cool app. It's free, and you basically get all this cash back. Now, no bank in Canada is giving away that much when you pay your bills. Usually you get nothing when paying your bills through the bank, so this is kind of a nice way to get something. And as a sponsor of the show, like I said, Paytm is giving away $10 cash back to all Build Wealth Canada listeners when they make their first bill payment. So to get that, just download the Paytm app from the Apple App Store or Google Play. And when you run the app, just choose the type of bill that you'd like to pay. And when you're paying that bill, enter the promo code BuildWealth. So when you're paying your bill, there's a little spot there for the promo code. Just enter Build Wealth. And when you do that, you'll instantly get $10 cash back on that bill. So it's basically, free money that you get as a thank you for, trying out the app to pay your bills and get the cash back and that kind of thing. So that promo code again is Build Wealth, just all lowercase, no spaces, to get that $10 cash back. And if that bill is over $50, then you're also now automatically entered to win the iPhone 10. So that's pretty cool. So a big thanks to PayTM for supporting Build Wealth Canada and putting up some pretty neat prizes like the iPhone 10. I definitely wasn't expecting something that major. So I wish you the best on the giveaway. I wish you have a wonderful talk with Ed if you choose to kind of take him up on the offer to get that free 30-minute consultation. And now, let's get into the show. All right, Ed, welcome to the show.
Thanks, Cornell. I've been looking forward to it.
Me too. So Ed, to start things off, can you tell us a bit about yourself and how you got into financial planning?
All right, actually, going way back, I actually started off with a whole career in accounting as an accountant for a few different companies. And then I just finally got interested in my own financial planning and my own long-term plan to retire early and investing. And eventually I found that I wanted to advise people instead of advising big companies. So I started my own planning firm. I did it on the side for the first couple of years. And I was fortunate to get a contract training financial planners. So I trained over 200 financial planners with the major credit unions. Introduction to financial planning and introduction to mutual funds. This was back in the 90s, and I found the course helped me organize my thoughts a lot. And then I actually really enjoyed doing all the in-depth writing financial plans for people. And I found it was actually often a struggle for many people, when you actually figure out how much you have to invest to have the retirement that you want. For most people, they couldn't make it, so we had to compromise and find ways to do that. And I found that whole process of struggling, of figuring out the sacrifice, how much you want to sacrifice your lifestyle now to have what you want later on, and what options you have with that was all very fascinating. I ended up finding that all the other planners that I knew, I hung around with a whole bunch of them, and all of them said that they did planning, but none of them actually did. And I found by doing the planning, I developed an insight into what really works and what doesn't. And my insight ended up being very different from what I call conventional wisdom. What do you read in most places and what's on the media? And I learned what really works. And so that's why I started up my blog, Unconventional Wisdom. And it's my way to try to educate the public into what really works, like how to have the life that you want.
So you mentioned with some of the advisors, they weren't actually doing the planning. Is that just because they were primarily just focused on selling investments as opposed to actually doing the plan for you or for the clients?
Yeah, it's actually kind of shocking. Mm-hmm. I call it the big lie, but it's the entire industry is very much focused on selling and investments. Mm-hmm. And I think, I haven't really seen a really good study on this. When you ask people if they do a plan, they all say that they do one. And in fact, if you ask people if they have a plan from somebody, a fair number of people will say yes, but nobody can actually produce it. Mm-hmm. But from looking around, I think the fact is that probably less than 1% of financial planners, even certified financial planners, have written even a single financial plan in their entire career.
And is that just, you think, because that's just not where the money is? Is that primarily the issue, you think?
Yes. It's a lot of work. It's complex, and to do it, the way that we learned it when we did our CFP course, it's complex to do, and you get paid on the investments. Mm-hmm. Most of the industry gets paid on the investments, so they just dive right in. If they can sell an investment, that's all they want to do.
So is it often that just the financial plan has to be kind of good enough so that the client can say, okay, I've got some nice charts. It's going to, I feel like, they gave this some thought. Here are some of my investments are going to grow. I keep thinking of those bar charts they always show you, right? And then that's kind of it. And then, but the majority of the conversation is all about, okay, let's get you investing as much as humanly possible because they're going to get fees on the back end.
Exactly. No, I have with most financial planners, when you meet with them, they're actually straight, within the first 10, 15 minutes, they're already talking about investments and
Right.
and asset allocation. And then you get something called a financial plan. The cover page says your financial plan's got your name on it. You open it up, and it's a one-page investment presentation.
Right.
And that's all it is. So and even I've had a number of people that have got a plan, like a 40-page plan from somebody, but when you talk to them, they said they talked to the planner for 5 minutes. He answered a few questions, keyed a couple things, and it printed out 40 pages, but they don't know what it is.
Yeah.
And so because when I asked them, so you have a plan, so when are you retiring? What do you have to do? Are you doing it? And they have no idea. So then you don't have a plan if you're not doing it.
But it looks like they did a lot of work on it when it's a very giant document, right?
Right, they hand a giant document there. It's okay. There, I did the financial planning. Now let's talk about investments.
Yeah. And then it's like, don't worry about the details too much, because I'm gonna work with you throughout to make sure the investments are taken care of as per this 40-page plan. And so I think it's like an alternate marketing angle, right? As here's all this work I did for you. Now let me implement it, kind of deal, right? So
the entire industry is set to market with a claim that you do financial planning, but really get straight over to investments. And the interesting thing is, what I found from experience is, I think I have a really good investment philosophy, but I think I make a much bigger difference in my clients' lives with the plan than the plan is the biggest thing, because now you actually sit down. We define, for example, the retirement plan is often the biggest part of it. Financial independence.
For sure.
So when do you want to retire? How much money do you need? How much do we have to put away to get there? And how are we going to invest it? And it's that whole process of figuring that out and figuring out with your cash flow and with your taxes and with your debts and your other goals. And it's that process that makes the big difference, because most people, before I see them, aren't putting away nearly enough.
Right. And I like that part of the financial planning process where you actually sit down with them and say, okay, here's where you want to get to, here's what you have to do. And if that's not reasonable, then it's good to have someone like yourself, for instance, where you can say, okay, well, here's the levers you can pull to still get there. And here are the things that you could potentially sacrifice on. Which one of those are you willing to sacrifice on? Which ones are you not? That kind of a thing. It's good to know.
Exactly that process. So when I do a financial plan, I do it in front of the client where they look at the software and they can see it. And most of the time, the first draft, okay, we're not putting away enough to get where we want to go. So we have a few options. So you can retire later, or you can invest more, or you can retire on less. Or we can sometimes I've learned various strategies that you can do that may help you get there. Often more aggressive strategies, but you have to look at, there's a few options, and you can adjust each one of those options until you get a plan that works for you, that's somehow reasonably doable, and yet still gives you a good result at the end.
For sure. Yeah, no, that's awesome. So let's dive into some of these kind of more detailed strategies, because I know you'd focus a lot on kind of some maybe even not as common strategies, but ones that can really save you a lot of money in taxes or help with your returns a fair bit. So one of the strategies that I wish I knew more about back when I was younger was how to actually make your mortgage tax deductible. So our friends in the US, they're able to basically deduct their mortgage interest against their taxes, whereas as you know, this is generally not allowed in Canada. However, you suggest a strategy called the Smith Manoeuvre for Canadians, which basically, when properly structured and deployed, it can actually let Canadians also deduct their mortgage interest. Can you talk a little bit about that?
Yeah, actually, interesting, because I've developed a bunch of different strategies, but I've kind of gotten known for this one. But it's one that actually works for a fair number of people. And in short, what you're doing is you're borrowing against your home to invest for your retirement. Okay, and it's kind of an elegant process that's designed so that you use the equity as it becomes available. With each mortgage payment, you're paying a bit of principal. We can borrow that little bit amount back, and invest that amount. And there's a way to actually we call it capitalize the interest, have the credit line pay for its own interest. So the whole process takes no cash flow. And where I found it useful is, the struggle we were just talking about for retiring or becoming financially independent. So if you're not putting away enough money and you don't know where to find more money to put away, yet you don't want to work longer. One of the options is you use your home equity to invest, and it gives you a whole bunch of extra money that you're investing towards your retirement that's not using your cash flow. So you can still do your RSPs and TFSAs and everything else you're normally doing, but this is an extra amount. And I found in a lot of cases that made the difference between being able to achieve, for the clients being able to achieve their life goal versus not achieving it.
Mm-hmm, mm-hmm. Yeah. So
it's actually a very cool strategy. I should add that it's definitely not for everybody. It is kind of cool. There's significant benefit to it, but you're borrowing to invest against your home, and that's definitely too risky for most people.
Okay. So how do you figure out whether this is something somebody can handle or if it's too risky?
Yeah, that's actually quite a detailed conversation I have with every client. About how much risk can they handle and what happens. So we borrow some money to invest and it goes down, and this should be a long-term strategy. So it is going to go down at some point, right? There'll be some market crash or some bear market somewhere in the future, and I have to become convinced that the client will stick through it through whatever happens, because if anywhere in the next 30 years there's a big market crash and you sell, then this was a horrible idea. Right? You have to be able to stick with it all the way through. And it's you don't have the same risk issue with other investments with RSPs, but somehow it feels different if you borrowed the money.
For sure.
It could be the investments fall and they're worth less than what you've borrowed. But you got to stick with it long term. So you have to have the right risk tolerance for it.
For sure. Yeah, because I could see it's one thing if the markets are doing well, the stocks you bought are issuing their dividends, and that's covering your interest payments and things are rolling smoothly. I mean, that's one thing, and that's kind of an easy thing to become okay with. But I could see kind of if the reverse, or when the reverse happens, where you're still paying that interest for that borrowed money every single month, but those investments are now worth less than what you bought it for. And then maybe some of those companies started cutting their dividends because we're going through a recession, that kind of a thing. So now, what if those dividend payments are no longer covering your interest, and now you just feel like you're, kind of pumping money into something that's losing money. And if you can stomach that and hold it longer term like you're supposed to, then you recover okay. But I can see it being especially painful if, for that time period where you're paying that interest every month, but you're not seeing the dividends come in to offset that, and I could see that getting really, really painful for someone.
Yes, yeah. If it's worth less, it can actually be quite scary.
Right.
Now, just to be clear, we're not actually using the dividends to pay the interest. In most cases, we try to invest with as little as tax efficiently as possible. And we're actually capitalizing the interest. We're having the credit line pay its own interest.
Okay.
So your investment credit line just grows and it pays its own interest, and that's why it doesn't take any cash flow. You obviously still have to pay it, but you're borrowing to pay the interest.
Oh, okay, I got you.
As well, that's how the process works.
Oh, okay.
So, but you can still have the risk of being, investments being less than the loan, and you have to think of it as a long-term strategy because it is part of the retirement plan, and I think the reason it needs to be a long-term strategy is that the best way to do it is to invest in equities and stock market type investments, and they are pretty unpredictable short and even medium term. But what most people miss is the stock market is actually quite predictable long term. So if you're in 25 years or more, the stock market has historically always produced a gain. So the worst ever gain in the worst ever 25-year period was a gain of 5% a year. You're quadrupling your money. Mm-hmm. That's the worst that's ever happened in a 25-year period. Mm-hmm. And in the last 80 years, the worst 25-year period was a gain of 7.9, like 8% a year. So if you're in a long term, you have a very high chance of getting a good result. That's why I think it should only be done as a long-term strategy, as part of as part of a plan. I've had some people say, let's just try it for a year or two and see how it goes. And that to me is a big red flag. No, we're not going to try this. We're either going to decide it makes sense for you and we're going to commit to it long term, or we're not going to do it. Right.
Oh, okay. Yeah, no, I'm glad you made that distinction there. Yeah, because it's not something. Okay, well, let's try it for a year and then see how things go. It can't be that short-sighted, essentially. So I guess when a client says that to you, then that's an immediate flag that okay, maybe this actually isn't a good fit for them.
I won't help somebody implement it if that's what we're doing.
Right. Okay. So no, that's interesting. Yeah. So it has its risks, like you said. It's not for everyone. Okay. Yeah. No. So that sounds good. So it's a strategy that. So it sounds like if somebody is struggling being able to invest a significant amount, let's say every single month, and they're concerned that, okay, after I pay off my mortgage, after I do my mortgage payments, after I do my monthly expenses, I really don't have that much left to actually invest on the top of what I'm currently doing. So you're saying in those cases, this strategy could be beneficial because it doesn't actually impact their cash flow. Is that correct?
Yes, it's one option that they can consider.
Right.
That can help achieve the retirement goal.
Right. But then, like you said, it also comes with kind of a whole set of risks, and it's not for everyone. So, so it sounds like it's something that when you're talking with clients, this isn't something that you jump to immediately. It's more something where you get a good idea of their financial situation, and then based on what they tell you, based on what their goals are, then you figure out, okay, could maybe they use this to their benefit a little bit more, or is this simply not a good fit at this point? Is that pretty fair to say?
Yes. Yeah.
Okay.
Yeah.
Sounds
you
good.
get to know the client and what their risk level is, and does it actually make sense for them? So the benefit can actually be quite significant. I have a software that actually calculates the projected benefit based on conservative assumptions, and generally with just the standard Smith Manoeuvre, the projected benefit is usually double your mortgage. So if you have a $300,000 mortgage, then over 25 years, the projected benefit's usually around $600,000, and that's just from the standard. That's after tax and after the interest payments, and that's just the standard Smith Manoeuvre. There's actually many ways to do it. You can go big or small, or there's 7 different categories of Smith Manoeuvre related strategies. Lots of ways to do it, but the benefit can be quite significant. But the bigger benefit is when you borrow more larger amounts of money, and you just have to be comfortable with that.
Right. Yeah. No, that's great. So it is a big enough of an amount where it is worth your time to actually look into it and actually determining whether it is something that you should consider doing or not. But also, you shouldn't just blindly go into it and just be all keen on doing it when you don't really know all the details and kind of the negatives and the drawbacks of that. That makes sense. But yeah, no, that's a very giant, attractive amount. And I mean, and it's interesting, right? Because when I first got into investing, everywhere I read it was like, okay, don't ever do leveraged investing. It's a bad idea. Just don't do it. But then, just having this podcast, talking to other investors, there are people that do this successfully, and they are able to handle it, and they are, they are benefiting quite a bit from it, like you said. So I find it's not as black and white as I thought when I first started years and years ago. It really kind of depends on the person. So I'm glad you shared that.
Yeah, I can say I've helped over 300 Canadian families implement it. Plus, I've advised a lot of people online who are trying to do it online and themselves and ask me questions. But about 2/3 of the people that approach me to do it, I tell them it's not a suitable strategy for them.
Yeah, and I can see that because I mean, years ago when I first heard of it, I just thought, what? You can make your mortgage payment, your mortgage interest tax deductible? This is amazing. And it sounded like the best thing ever. I think I got some flyer in the mail or something that talked about it, and I got really intrigued about it. But then, of course, as you start kind of peeling back the onion, you start seeing, okay, it's not necessarily that simple. There's a bunch of caveats to it, and it has to be done properly. Especially if you don't want the government on your case, right? Because there's a whole that's another question. But yeah, there's also that whole component. But yeah, so I get the impression though that a lot of Canadians, if they do choose to use the Smith Manoeuvre to get make their mortgage interest tax deductible, oftentimes they do it with their primary residence. Is that right? Yeah. So what if somebody, let's say, has their mortgage paid off or has a rental property? Is it highly beneficial to still use kind of a variation of the strategy? So basically taking out equity from your home, using a home equity line of credit, for instance, and then using that for the leveraged investing.
Yeah, so if your mortgage is paid off on your home, you can just borrow. You could borrow up to 80% of the value and invest it right off the bat. Like, so basically, you're at the end of the Smith Maneuver, but from there, if you've got a good time frame in front of you, you can get a benefit much more quickly. Than the Smith Maneuver, if it starts out so small often and gets big over time. If you have a lot of equity, you could start out with a much bigger amount.
Gotcha.
Right. So
if your mortgage is paid off, what you would do is would you just basically get a home equity line of credit, take a portion, whatever amount you're comfortable with, take that out as a loan, and then would you now then be investing it in relatively sustainable, or I should say stable, dividend paying stocks in Canada? Would that be the kind of idea, so that the dividend payments offset the interest that you're paying? Is that how you would structure it?
No, we'd still. I mean, I've always done it with mutual funds. I very much believe in professional management, but I'm also looking at, I want to invest all over the world, and I want to be tax efficient. So we're looking for generally global funds with all-star fund managers that have the lowest tax possible, and we're capitalizing the interest. We're not using the dividends to pay it.
Okay, gotcha. Okay, sounds good. Yeah, because I've heard some variations in the past where people they'll kind of do the strategy I just kind of mentioned, where they want to get the dividends, they invest in companies that produce a pretty good yield, and then use that to try to offset the interest payments, and then that's kind of how they do it. But your approach is a little bit different, and it's more kind of it sounds like it's more diversified and less dependent on dividends.
Yes, yeah, we're not dependent on dividends. Plus, we're diversified all over the world, and all that. The dividend investing is it's something that's been popular. It's one of the themes that's been popular since 2008, and everybody's scared of the market, and they're looking for anything with a yield. So, investing has been popular, and we're in kind of a strange time where interest is so low, interest rates are so low that dividends actually cover it.
Right, exactly.
Or they can cover it if you pick the higher dividend paying stocks, but in most markets they don't necessarily cover.
Right.
So I've also modeled it. I've looked at, okay, what if we let's say, for example, we invest in a fund that makes 8% a year long term, versus we have one that makes 5% a year of growth plus a 3% dividend, and over 25 years, where are you at? And what I found, and usually you're always quite a bit ahead when you don't get a dividend, because it reduces the tax refund that you get every year.
Okay, gotcha.
Right? So the theoretical benefit of the strategy is lower. I find if you're investing in dividend-paying stocks, you need to make almost 1% higher rate of return in order to offset the extra tax you're paying.
Oh, okay. That's very interesting. Yeah, I like talking to you, Ed, because you always have those kind of the common popular wisdom that you might see, on a lot of blogs and things like that. And then I like how you take that and you plug it in, you do the math on it, and you say, actually, this doesn't always work the way everyone thinks it does. And actually, there's a more optimum way of doing it. So no, that's really interesting.
That's what I love. That's why I call it unconventional wisdom. That's my blog.
That's right. I like your blog posts because they're usually pretty controversial against that popular wisdom. So, or the kind of popular sayings that everyone hears all the time. So it's interesting just to kind of get a better understanding and not to just kind of generalize things. And then with rental properties, is that kind of something? Is this strategy applicable to that as well? If somebody owns a rental property, is it the same kind of deal?
Yes, you can do it with a rental property as well. And people first think, well, rental property mortgage is already tax deductible, but really, so the Smith Maneuver converts your mortgage into a tax deductible credit line. It doesn't make the actual mortgage tax deductible, but it replaces it over time with a credit line. And the same with a rental property. As you're paying it down, you can re-borrow to invest, and so it's converting to a credit line that's tax deductible for investments. As you pay down the mortgage, that's deductible against the rental property. And it's actually useful to do with a rental property because a rental property with a lot of equity in it is actually a very inefficient investment for tax purposes because
Right.
the rent is all fully taxable, right? So you don't have a lot of tax on a rental property when you have a huge mortgage. But if you have a lot of equity in it, you're getting all this rent and there's a lot of tax on it, right? So it's useful. It actually works quite well with a rental property because you keep you keep your credit line pretty high. Your tax deduction for the Smith Manoeuvre offsets the rent, and meanwhile you have these other investments.
Yeah, yeah.
So-
It's interesting with the rentals. I remember because we still have a rental property, and it's like the more of the principal is paid off, or like the smaller mortgage you have, the more principal you have in the property, the lower your return actually gets, right? Because you're becoming less and less leverage the more and more you pay off the mortgage. So yeah, it's interesting how that kind of, because it's like, oh, you want to pay off your mortgage, that's kind of the default, right? But then you're like, oh, it's actually lowering our return now because now we're becoming less leveraged.
But rental property, it's actually best to keep the mortgage as large as you can.
Right, yeah, because you're deducting the interest off it, and then so no, that's interesting. So you can almost be, I guess, like double leveraged in a sense, right? Where you're leveraged because you're taking on a mortgage on the rental property, plus you're using the Smith Maneuver as well to take any equity out that you've gained on the property. So this is kind of another way to, I guess, grow your returns, assuming you're okay with the leverage and the risk that comes with that, right?
Exactly. Yes.
Yeah.
You're getting, if you're doing multiple properties, it's getting bigger. You have to be comfortable
Right.
with it. But very often the rental property, usually what we do is, if you have a home on rental property, you don't want to pay your home mortgage as fast as possible and the rental one as slowly as possible.
Right.
Which often means that the Smith Manoeuvre on the rental property is fairly small.
Right.
But the useful part about it is I find people that have a rental property, often they have 80 or 90% of their assets are in Canadian real estate.
Right.
And so it's useful. It's very good to diversify and have. I find it's generally good to have at least half of your assets in stock market and equity investments.
Right.
Instead of having it all just in real estate. And equities and real estate actually are good diversifiers for each other.
Yeah, that's a good point. Yeah, no, that's definitely true. Yeah, as soon as you get into the real estate rental game, I find your whole portfolio allocation gets out of whack because it's like you buy one property and all of a sudden you're like, oh, I'm over 50% now in real estate, just because the amounts are so high, right? Relative to your stock portfolio.
Because if you count the value of your house, plus not the equity, but the value of the house and the value of the rental property, compare that to the value of, take all the investments you have and how much in stocks, how much is in bonds. A lot of people find they're 80 or 90% in real estate.
Yeah. That's what we were in at one point. I was like, okay, no, I'm not buying more real estate. I need to, and we ended up selling one because it was just, I'm like, this is not normal. This is going against everything everyone says about diversification, right? When you're holding 80, 90% in real estate.
It's not very diversified.
Yeah. So, no.
But just interestingly, I have, I've helped a fair number of people do it with a rental property, and my record is 7 properties with one client. We did Smith Manoeuvre on their home, 5 rental properties, and a cottage.
Wow.
7 rental properties, 7 Smith Manoeuvres, all with one client.
Wow. And they're able to sleep all right at night with all that leverage?
Well, most of them were fairly small amounts. The home was the bigger one.
Oh, okay. I was like, I admire their ability to just stomach all that, because I would say most people can't. We get pretty nervous, right? Anytime there's a big market swing or anything like that.
Yes.
Yeah.
Well, there are some people. I've run into a very small number of really aggressive wealth building people that just want to build as much wealth, and they have no trouble with leverage and as high as possible, and doing the Smith Manoeuvre, maybe even getting a separate investment loan on top of that, and they're looking for how do we maximize it all?
Oh yeah. No, it's a different breed. Yeah.
But it's a very small group of people that are like that.
For sure. Yeah, I think everyone wants to maximize, but not at the risk, not at the risk of basically increasing your risk so drastically, right? And having to put up with all that volatility and all of that. So yeah, no, for sure. But yeah, some people just kind of they want to, I guess, see how far they can take you, right? It's like it's like a challenge for them. So no, that makes sense.
Yes,
but yeah, so
because we always look at, like, it's not only how much you borrow today, but let's say if we're going to do it on two properties, let's flash ahead 20 years and see how much you would owe 20 years from now.
right.
And so if you're not comfortable with the figure at the end, let's not start on this road unless you like where it's going.
Yeah. You've got to be extremely comfortable with that to do anything close to that for sure.
Yes.
Yeah, no, that's interesting. So, I mean, I've researched the Smith Manoeuvre a bit in the past, and I mean, a common theme that I've noticed seems to be that you've got to be really careful with how it's all set up, or the Canada Revenue, and just basically so that the Canada Revenue Agency doesn't flag you and treat this whole thing as tax avoidance, where you end up paying all kinds of fees. So, can you talk about what to be careful of? What are the common mistakes that Canadians make when they try to set this up by themselves without any sort of help?
But just to be clear, tax avoidance is legal. Tax evasion is not. That's the difference.
Evaded, sure.
Yes.
Because I think that's what they would charge you with, right? Is it tax tax evasion or accusation of tax evasion, I guess, is what they could technically try to charge you with if you did it wrong?
If you if you do it as a somehow as a sham in some way, but the important thing is that you need to have a good tracking. So what Revenue Canada is looking at is what they call the current use of the money. So if you ever audited, and actually because we have quite a few clients doing it, and we do their tax returns, we end up dealing with Revenue Canada. We get audits from them quite regularly, or a request for information. Pretty well every year we get a few of these requests for information. So we know how to deal with it. But whatever Revenue Canada is looking for is a clear tracking. They have to show that the money from the credit line went to the investments and that it's still in those investments. You didn't somehow take money out of them or something.
Okay.
And track it, and you got to be able to show the transactions to show that that's where all the money went.
Right.
So it can also be used for. It's okay if some of the money from the credit line was used to pay its own interest. So the tax rule is if the interest is tax deductible, then the interest on the interest is also tax deductible.
Gotcha.
But basically you need a clear audit trail of it. There's ways that you can make it more clear that way.
Right.
You need a clear way to track it, maybe with a separate checking account, or there's things you could do to make it clear. That's the big thing to watch out for.
Okay, that makes sense. Yeah, everything I've ever researched about it was always like, make sure you've got someone that make sure your account knows about it. Whoever's doing get some help on this basically, because you want to make sure that if you do get that request for information or an audit, that you're able to basically prove that everything is above board essentially, which it is, right? But you want to make sure you can prove it sufficiently to their satisfaction, or you're gonna get dinged basically, right?
Exactly. Yeah. It's funny, they can, if you don't know what you're doing, they can be scary. Like, it's not hard. You just got to track it. But when they ask you the request for information, it's a 2 or 3 page letter, and they have 10 items that they want.
Yeah.
And it can be quite breathtaking when you first see it, but it's just a matter of putting it all together.
Yeah.
But our response to it is often 20, 30 pages. It's a lot of detailed response, but it's not hard. It's just a lot of data that you have to be able to track.
Yeah, that makes sense.
And if you can't, what Revenue Canada does is they don't make an opinion on it. They just ask you to support it, and if you can't support it, they just deny it.
Oh, okay, gotcha.
That's what happens. They'll just deny the interest deduction then.
Oh, okay. So here, let's change subjects a bit. Let's talk about RESP. So a lot of Canadians, they hear about the free money you can get from the government if you put money in an RESP. It sounds like a really appealing thing. And I remember when we had our daughter, I got a whole bunch of calls from companies that were trying to quote unquote help us with setting up an RESP, right? And I put the help in quotes because obviously they're gonna they probably want us to invest in some high fee funds, and they get their cut or whatever the case may be. So to kick things off, can you explain what an RESP actually is, and is this something that we actually need a company to set up for us, or is this something we could easily do ourselves if we're a do-it-yourself investor?
Yeah, so RESP is a government program. It's basically just a type of account, and so if you open up an RESP to save money for for your kids, the government gives you 20% of whatever you put in, up to $2,500 a year. Okay, so you put in $2,500, the government gives you $500, and then which they put into the RESP, and now you got $3,000 a year that gets invested. So it's quite a good way to save, and the amount is actually fairly reasonable. If you start when your child is young, let's say 2 or less, and you put away the $2,500 away every year all the way through, and you invest it and make a good return, equity type investments, it's close to covers the cost of education. That's including tuition plus living costs and all that. So it works pretty well. Now, you don't need a company to set it up for us. Those companies that were calling you were actually not standard RESP. They're what we call scholarship trust or group RESPs. So there you're putting it into a plan where many people are in the same plan. Mm-hmm. So those scholarship trusts, they've been after me to use their product for years, but I don't actually like their product. So I can't actually find I can't get around, I can't recommend it to anybody. So their investments are entirely in bonds.
Oh, okay.
So it's very low rate of return, and yet when you calculate it, they show you projections what happened, and the returns aren't that low. They're like 5% a year, often if you look at what people actually got. Mm-hmm. But the reason for that is, and is also the reason I don't like them, is there's a whole list of restrictions with a scholarship trust, not with an RESP, but with a scholarship trust. There's a whole list of restrictions on getting your income. On getting the money out at the end. Mm-hmm. So your child has to go at age 18. They can't skip a year. And they have to, if they do skip a year, they have to announce it well ahead of time, and they can't change beneficiaries after age 14. It's like each one of them has a bunch of restrictions. Right. And what happens is about a third of the people that are in there lose all of their 18 years of growth. Mm-hmm. So if you put money into the group plan and your child doesn't go to university, you lose all the growth. Mm-hmm. All you get is your contributions back. That's it. Mm-hmm. Okay, so that's why I don't like them. So the RESP itself is a government program. You set it up. It's a type of an account, just like an RSP, and you put the money in, and then you can invest it in whatever you want to invest it in. Mm-hmm. You can use an advisor to help you invest it, or you can just buy whatever other investments that you would buy. And all the money gets invested in there, and then you don't have all those restrictions.
Mm-hmm. Yeah, I know what we had a family member actually that kind of got talked into that, and yeah, they got hurt by that pretty badly because their son ended up not kind of going the traditional route. Like you said, there's all these different rules, so he didn't do kind of the traditional go at this age, and like he kind of switched around, things like that. Long story short, yeah, they lost quite a bit of money with that kind of approach. So so I know what you mean. There was quite a bit of tension in the family. I remember when it happened. Yeah.
Yes. Yeah. Yes. I think a better route. Don't go with a scholarship trust. Go with your own RESP. Mm-hmm. Invest it, at least, especially when your child's young. Invest it. It's probably similar to what you do with your RSPs. Mm-hmm. And just let that grow.
Yep. So do you start, like, let's say your child is, let's say 2, like really, really young, you're starting the RESP for them. Do you start with a diversified kind of all stock portfolio, and then do you use some sort of a formula then to know how much you should move into bonds every single year to make it more and more, or to make it less and less volatile as the child gets closer to actually having to take that money out?
Yeah, so that question is all based on risk tolerance, so it's different for every client. Mm-hmm. So in most cases, when they're younger, we invest them the same as their retirement money. Mm-hmm. So and a lot of cases that's 100% equities. Right. I think that's fine when the child's younger. You got a long-term time horizon in front of you, or at least quite a few years. Now RESP though is a shorter term time horizon than your retirement money. Right? Because it's only 18 years, and most of the time they take the money out within 4 years or 4 to 6 years. Right. While retirement, you invest for 30 years and you take it out over 30 years. So retirement is a much longer time horizon. So, but it's interesting when you get to the last few years, it's whether or not you switch to more to part bonds. I guess it's a very big risk tolerance questionnaire issue because most likely you will have the most money if you just leave it 100% equities all the way through and just take your money out and just leave it 100% equities. Because, even if you're, 2 years, let's say your child's 16, going to go to university in 2 years, but then you're going to take it out over 4 years or 4 to 6 years. So the money is going to be invested for between 2 and 6 years. And in that case, the odds of the stock market being up over that period of time is about 85% or a little more.
Okay.
So most likely you're going to make more money. 85 out of 100 people will make more money being 100% equities versus bonds. So when you put bonds in, you should always assume you're probably going to get less. You're probably going to get a lower rate of return, but there is a certain chance that that your investments would fall more and you'd make less.
Right.
So if you're in the last couple of years, part of it is whatever risk you're comfortable with, and part of it also is how important is it that you need every dollar that you have. If you just have enough for tuition and you're only covering tuition, and if you lose some money, then you don't have tuition, and what are you going to do instead? Then you can't, you really can't maybe you can't take the loss.
Right.
But for a lot of people, they can. In fact, what'll happen is their kid will take a student loan anyway. And we've actually had cases where somebody saved up an RESP, had a higher risk tolerance, left it all in equities. Investments did go down. The child just took a student loan, and then we took it out closer to the end before they finished school. We took it out, and we actually ended up being up anyway.
Oh, okay.
So yeah, it's even over short periods of time, the stock market is up. Remember, it's up about 3/4 of 1 year periods, and 85% of 3 year periods, and 95% of 6 year periods. So most of the time you're still up, and that's the whole issue with it is a discussion of what to do in the last few years.
Yeah.
But to be honest with you, for most of my clients, we've left it as all equities all the way to the end.
Okay. What if someone says, I don't feel comfortable with that, I'm too scared that, like, let's say, they're afraid that 2008 kind of happens, let's say, a year before their child goes to university, right? So they're terrified of that. They want to really lower the risk of that happening. What kind of is there an allocation that you would recommend for something that's very conservative like that?
Yeah, like when we've got more conservative people like that, we often we switch over to balanced funds or half in balanced funds. So Let's say we're 25 or 50% in bonds, maybe starting at age 15. All right. So in the last 3 years, plus there's 4 years of withdrawal. So it is, we're in the last, say 6 years of, our time horizon when most of the money will be invested is about 5-6 years. And maybe that's the point where you should maybe start looking at getting more conservative.
Okay. No, that helps. Yeah, I think it's just nice to have a bit of a benchmark for those that, do want to have that extra bit of security, essentially, right? Because for sure, like, I don't know, like, I think I have a pretty high risk tolerance, but I would still be nervous if it was, like a year before my daughter goes to university and I'm all equities in her RESP. I don't know. I know there's that whole psychological thing too, right? Where you're like, what if something happens and that kind of a thing. So that helps. Thanks, Ed.
Yeah. The stock market has historically 85% of market declines. The market came back within 1 or 2 years.
Right.
So even if you're taking out over 4 years, so even if there is a crash, there's a good chance that you'll come back in between.
That's a good point. Yeah, it's not like you have to. Most likely, you don't have to withdraw all of it in that first year. Like you said, you can hold on. Like with your one client, withdraw a lot of it or most of it, let's say in their 4th year or something like that, or 3rd and 4th year. And like you said, by that time, there's a good chance that the market has at least recovered a bit.
Right.
Yeah, that's a good point.
Where age 15 comes from is, I think, okay, you're taking out over 4 years, so let's count 2 of those. That's on average. That's how much is invested in 3 years before that. So at age 15, you've got, let's say, a 5 to 6 year time horizon, right? And that's where the success rate of stocks falls below 90%. So based on history, 87% of 5 year periods the market is up, but 94% of 6 year periods. Right. So once you're down to from a 6 year to a 5 year time horizon, maybe that's the time to start thinking about adding bonds.
Okay.
That's where age 15 comes from. It's it's there is some science behind it.
Okay. Yeah, no, that's great. Thank you. Yeah, I've been getting quite a bit of questions about RESPs on the show, so I'm glad you were able to cover that in a fair bit more detail. Yeah, no, that's great. So let's say let's switch gears a little bit. Let's say you had to retire tomorrow with $1 million portfolio, and you have no debt, your house is paid off, but you have no work pension as well. How would you structure your portfolio, and what investments would you buy so that it would last you indefinitely, or to maximize your chances of it lasting you indefinitely?
Yeah, that's a great question, Cornell, because I actually found it really interesting when I studied that. I studied that in depth. I went through 150 years of data of stocks, bonds, cash, and inflation, and I looked at what happens, what would have happened historically. Would you have made it through retirement? Based on what you did. And so what I was studying, I started off with the 4% rule, which is a rule of thumb that financial planners use, that you could take 4% out a year. So I thought, okay, let's see, is that true? Would that have worked? And what I found, which was quite surprising, was it does work with if you have a very high portion of equities, at least 70%, or even better off 90% or more in equities. But it does not work if you're mostly in bonds. And most retired people are mostly in bonds, right?
Right.
So it's when you're, and the reason is it's a 30-year retirement, which is a long-term period. In my study, I defined success as I take 4% out a year and increase it by inflation for 30 years, and I don't run out of money for 30 years. So, and over a 30-year period, believe it or not, stocks are more reliable than bonds. If you take 30-year periods of time, you'll find the stock market standard deviation for 30-year blocks of time, the standard deviation after inflation, is lower than it is with bonds. So I found that there's a lot more cases where bonds didn't work. In fact, about half of the time, bonds you ran out of money in less than 30 years, and yet with stocks, it was about a 97% success rate. So when you're retired, trying to take the maximum reliable income, the most reliable income is if you're very heavy in stocks and have hardly any bonds. Now that's completely different from what most people think. You think you think stock bonds are safer, right? But what happens is stocks go up and down and they have that risk, but they do come back over time. And if you invest for 30 years, they come back. Bonds, however, get killed by inflation. So anybody in the last 150 years who retired and there was a period of higher inflation somewhere in their retirement, they ran out of money when they were all bonds.
Okay.
Yeah, so that's that whole study. Actually, it was quite an in-depth study. I spent quite a lot of time researching all of this, and found it really interesting. So it's all on my blog site. But I also looked at different, what should it be instead. So most people that are somewhat more diversified should take 3.5 or 3 or 2.5%, not 4. And I also looked at all kinds of different options for different allocations, and what if we made up a rule where we're going to not increase it in some years? I looked at all kinds of different kind of rules. Maybe we reduce it if the market goes down too much. And I looked for how do I set up a process where we can take more than 4%. And I found there's actually ways, if you're willing to occasionally take a bit of a drop in your retirement income, you could take up to 6% a year out of your retirement income and still be 100% reliable over 30 years.
Okay. Yeah, I remember reading that blog post that you read. It was really, it was really, really good. And yeah, it was interesting, especially, right, because it was kind of contrary to the to what we hear normally when we read just kind of general retirement advice. So it was interesting, to actually see your results after you crunch those numbers. Now,
it's a great unconventional wisdom.
Yeah, for sure. Now, would you change your investments and your portfolio structure at all once you hit 65? So what you just told me right now, I mean, I think this was more so if we're dealing with a kind of traditional retirement where, okay, you hit 65, you start getting CPP, you start getting OAS from the government. If you're, let's say, doing an earlier retirement, does that change things at all? Or I'm guessing not, right? You'd be just as much in equities, if not more, right?
Mostly, so just actually, I should add one point to the last thing is, being a very high in equities proved to be much more reliable in history. But I'm not saying everybody should do that. You still have to be comfortable with being all in equities, and most seniors aren't. So I'm not saying you should do that. It's an educational point that there's a benefit to doing it. So you should try to be as high equities as you can tolerate. But if when you're retired, you're taking money out. You're no longer putting money in, and a lot of people are much more scared about having equity fluctuations.
Right.
So in that case, you should still maybe have 70% in bonds and just take less income. Take 3% instead of 4%, or something. So so basically, you should set up your structure like it's part of your overall retirement plan. So you can get CPP and OAS and your RSPs and your other pensions, and you look at all the different pieces together, and you decide how much to take out of where, and what's the way to optimize the tax, so you could take out money at low tax brackets but not at high tax brackets, and avoid clawbacks. So you may adjust how much you take out here. It wouldn't necessarily, the CPP and OAS wouldn't necessarily affect how you would invest it.
Okay.
So
you just factor that in as extra cash flow, basically, and then you modify your withdrawals accordingly, because now you're getting the CPP, you're getting the OAS. But you're saying you wouldn't actually change the structure or anything like that, or what investments you're buying per se.
Right. The one thing that I did find interestingly is, CPP and OAS, you can get more if you delay it to age 70, and CPP you can start it as early as 65 or 60, age 60, but you get less. And when I studied that, a lot of people look at, which is the way that gives me the highest odds of getting the most money, and they look at age and when does it run out. But when I studied that, what I found the single most important factor was how you invest.
Okay.
Because if you take CPP, that means you can take less out of your investments and it can grow instead. And what I found is CPP equity investors should generally take their CPP and OAS as early as possible and take less out of their investments, while people who are balanced portfolios or who are more in bonds should take more out of their investments, and they should delay CPP and OAS as long as possible. So it's the age thing was one thing, when does it run out, but actually the single most important factor was how you invest. I don't think I've ever seen any other articles on CPP and OAS that looked at that.
Yeah, that's
but I'm
really
comparing the rate of return of the portfolio versus the rate of return you're getting, the implied rate of return by taking your CPP early or late.
Yeah, it makes sense, because so you're saying basically if you're heavily into equities, you're earning a higher return than you would be. You're earning a higher return, so you want to basically not take that out as long as you possibly can. Right. Or you do the reverse. Yeah, that's right. Okay, that makes sense. Yeah. Okay. And that's in the same article, I think, right?
No, I have a couple separate articles about CPP and OAS.
Okay. So I'll link to those in the show notes, and then people can just jump right. They can go to they'll go to the show notes of the episode, and then they can just click there, and then they'll get taken to your site with those. Because I think that's a really interesting. That's very interesting. Because I think a lot of people, at least just from ones I've talked to, they say, well, I want to take my CPP and OAS as quickly as possible, because what if I die? What if I miss out on money because I pass away or something like that? What's your response? Do you have a response to that? Because I'm sure you get that question a lot too, right? Where people just want to take it as early as possible by default, perhaps.
I think people sometimes don't realize how long most people live today.
Right.
Right, and so especially if you're married, like your spouse still gets 60% of your CPP, not the OAS, but 60% of the CPP. So if you're 65 and average health, you've got 20 years in front of you, and if you're married, the one of you could be there 27 years later on average. Like an average couple of age 65. With average health, one of them, the one that lives the longest, will make it to 92. So people live longer than you may think. Unless you know your health and you know you're not going to live that long, or you don't think you'll live that long. But so we do the math on average life expectancy, and let's assume your average health, and which way are you the most likely to get the most money? So and that's how that's how you do that. We're trying to help people make the smartest decision based on that.
Right.
So,
Makes sense.
but I've heard both arguments. One is I might not live long, so I want to get it as quickly as possible. And then people say, well, I make whatever it is, 8.5% rate of return by waiting, which you don't. You get 8.5%. You get or 6.5% more. Or you get a higher amount for every year that you wait.
Right.
Which is not your rate of return. It's just how much more income you get for a certain number of years. But I've had people say, look, I get so much higher rate of return, I should definitely wait all the way till the end and get all the extra CPP and OAS. So I've heard both arguments quite often, but I think it's actually worth looking at it and seeing if are you above average health or not, and especially how do you invest, and let's make the decision where you're most likely going to get the most money.
I like that. Yeah, how there isn't just a flat answer. That's always the best one. Where you should always take it as early or always take it as late. It really depends on the financial plan, their health, like you said, how they invest. Because that's an interesting one about how the investing piece, how that plays such a big factor regarding when you take it. No, that's awesome, man. No, thank you so much for sharing that. So can you tell us a little bit more about where we can learn from you?
So I have my blog, which is edrempel.com, edrempel.com, where also you can get to it from unconventionalwisdom.ca, CA meaning the Canada one, not .com, but unconventionalwisdom.ca. So, and I've got a lot of articles going back more than 10 years, and they tend to be the very in-depth articles on each topic. So there's a lot on there. I also have, if you go to that page right at the top, I have a video. It's 50 minutes long, but I've put together what I think are the single most important things that people I think should know about finances and about how to become financially independent. So in the less than a time of one TV show, you could learn all this stuff. So I find that video I think is definitely worth listening to. I also offer a free 30-minute consultation. So I think a lot of people aren't sure whether or not they should, should they just do it all themselves, or should they hire a financial planner and get a financial plan or work with a planner over time. And the 30-minute consultation is a way for us to get, you get to know me, we get to know you, we see if we're a fit, and you can understand the benefits, in your specific situation. So that's on my blog. You can just fill it out and request a 30-minute consultation.
Okay. No, that's awesome. Thanks. And yeah, I'll make sure to link to it as well from the show notes. So we'll have the articles in there, and plus a way if anybody wants to do the free 30-minute consultation. And then, lastly, let's talk about your practice for a bit. So what are some of the most common questions and problems that you tackle for your clients? Like you mentioned the Smith Manoeuvre already. That seems to be a very common one. Are there other ones that you find people really struggle with that need a lot of help with?
Yeah, I've gotten known for the Smith Manoeuvre, even though it's one of quite a few of these strategies that I do. It's the one that's kind of got that I've gotten known for over the years. So a fair number of people come to me just for the Smith Manoeuvre, but I really only do it for people where it fits into an overall plan. But probably the bigger thing I think is the comprehensive planning, and there's very few sources to get that in Canada. I've done so much of it. I've done over 1,000 comprehensive plans. So it's people who want to take control of their whole finances and know that they're optimizing everything. They can do that through, first of all, having a plan, and secondly, working with me over time to help them implement it. So, and of course, the financial plan, the biggest piece, of course, is your retirement plan, financial independence, and how do you get there and how do you do that? But there's always everybody has multiple goals. Education savings, because we're paying off the mortgage, and minimizing tax, and insurance and estate planning. And so it all fits into an overall, that's all part of what should be within your financial plan.
No, that's awesome, Ed. No, so thank you so much. That was it was great having you on the show. And I'll make sure to link to some of the blog posts that you mentioned as well, to the free consultation. And and then thanks for coming on and sharing your more advanced tactics, especially.
Yeah, my pleasure, and very, very much enjoyed it, Cornell.
Okay, that sounds good, Ed. All right, have a good one. Bye. All right, I hope you enjoyed that interview with Ed. Just a reminder that Ed is offering that free 30-minute consultation where you can get some of your questions answered. And you can get that by just entering your email at buildwealthcanada.ca/ed, so just ED. And I've set that page up so that when you sign up, you'll automatically be emailed the guide that I made on the top questions to ask your financial planner or advisor. So you can basically ask it some of those questions if you'd like, or ask your own, or use it on your own. If you already have an existing financial planner or advisor, you can use those questions on them too to see if they are still the best fit for you. And of course, don't forget about the big prize that you can win, the iPhone 10, thanks to our sponsor, paytm.ca. All you have to do is go to paytm.ca on your Android or Apple device, download the app, and pay one of your bills using either your linked bank account or Paytm cash, and using that app, and make sure the bills were $50, and you'll be automatically entered to win. Also, remember that when you're paying that bill, use the promo code BUILDWEALTH, all lowercase and one word, to get a free $10 cash back on that bill as well. So you're just kind of getting an extra $10 just as a thank you for trying the app. Plus, like I said, if the bill's over $50, you're automatically entered into the contest as well. And you can also go to this episode's show notes at buildwealthcanada.ca/39. So just the number 39 to see all the details of the contest, the link to sign up to have a chat with Ed, etc. And yeah, you can see everything there in written form. All right. So once again, a big thanks to our sponsor, paytm.ca, for putting up such an awesome prize. Have a great week. Enjoy your talk with Ed if you'd like some of your questions answered, and good luck on winning that iPhone 10. All right. Take care. Bye.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.